Hi, everybody. This is Ryan Hansen, and I am president at Tradovate. I want to thank you for taking the time to attend today's event. We're very excited to be sponsoring our second webinar presented by Jigsaw Trading. Pete does a great job of presenting on interesting topics. In the first webinar we did together on scalping last fall, got a great review from our customers. So we're very much looking forward to today's event on day trading the market open. For those of you who may not be familiar with Tradovate, we're a cloud-based futures trading platform that offers unlimited commission-free trading for a flat price. We don't charge per trade commissions, platform licensing fees, order routing fees, or mobile app fees for trades going through Tradovate's platform. And our platform has quite a bit to offer active traders, including things like volume profile to view volume at price data, market replay to play back a previous trading session using tick data with full market depth, and a whole lot more. So please make sure to sign up for a free 2-week trial that includes free real-time market data if you haven't already, and Pete will provide that link where you can find that at the end of the presentation. Jigsaw's depth and sales and reconstructed tape tools come included with the Windows downloadable version of Tradovate, which eliminates the need for a separate installation. We also have the price, action, swing, and cumulative delta indicators that Pete uses to create swing charts, and we're currently exploring the possibility of offering Jigsaw's standalone platform, Rapid Trader Pro, when it's officially launched. So anyone who's interested in trading commission-free on that platform should definitely contact us so we can let you know when it's available at Tradovate. With that said, I'll turn it over to Pete, and I'll be available in the Q&A portion of the event to field any questions that you may have about Tradovate.
Okay, thank you, Ryan, for that, and thank you for arranging this event today. Can I just do a quick sound check? Can everybody hear me okay? Yeah, we got somebody who can hear me. Now, if the sound does go, there is kind of a glitch with GoToWebinar. If the sound does go, you'll find if you log off or log back on, it will come back. So today, I'll just put the disclaimer up. I don't really need to go and explain that. We've all seen that before. We're going to discuss trading the open. Now, that's not the opening range, which is kind of a very traditional trade, but we're talking about the open itself. So not the first 90 minutes, but actually the first few minutes. In some cases, taking trades within the first couple of minutes of the market opening. And now, as with any trading opportunity, there's more than one way to approach this in terms of trade management, and we're going to discuss that too. But the opportunity itself is often available within seconds of the open. Now, this is something that you don't have to take a leap of faith on. It's something that you can actually take a look at, because at the end of the day, most of us are actually sitting at the screen at the open anyway. So it's one that you'll be able to see quite clearly for yourself. You know, if you take time over the next few weeks to look out for the things that we're going to discuss. Now, of course, this does fly in the face of conventional trading wisdom that specifically tells us, a lot of educators say, you need to avoid trading at this time. So a lot of people will wait for the first 15 minutes to pass to kind of let the market show its hand before they consider placing a trade. Absolutely nothing wrong with that in the context of the way they trade, okay? But it doesn't really mean it has to be a rule for everybody. And quite often the rules or the reasons given for not trading the opening minutes are, first of all, it's too volatile. And it certainly can be volatile. It is going to swing one way and then the other very quickly. But that doesn't mean it's too volatile to trade. And the behavior there is predictable to an extent. And that kind of predictability is something we're going to take advantage of. Another reason for not trading the open that people give is there's no high or low range for the day yet, and you know, the previous day range extremes may be quite far off too, so there's no reference points to play off for the day, and that's a valid observation. Specifically for index futures, the institutional equity trading is just starting at the open. And there is a case that says, you know, the stocks and futures need to kind of realign. Now, on days where the S&P futures opens 50 points down, that is a very valid point. But most of the time, the futures aren't really opening far enough, you know, from where we closed in the stock session that's really going to affect this setup. You know, I've seen articles out there that say that trading in the first 5 minutes is nothing but gambling. And there's a lot of other reasons out there too that say don't trade the open. And the advice not to trade those first few minutes, it's not really terrible advice, it's just really generic advice. So, many traders wait for the opening range to form and then they'll play off that. And that opening range is the first 30 minutes of trade. So a lot of traders will use that as a reference point, playing breakouts or reversals. A lot of people do that on crude. Now, there's nothing wrong with that. But one thing is certain, when you trade the opening range, you're going to be trading an area where a lot of other traders are looking to get positioned. So it's a common area to play off. And that does mean there'll be a lot more predatory traders, looking to take advantage of the additional stops often built around the area. But the big issue with this don't trade the open, it's just a wide sweeping statement that applies to all markets and every day as if it's written in law. And as we're going to see, there is opportunity there. Now, not all of the market opens are equal, and why would they be? And not all markets open in the same way, and why would they? But today I'm going to show you something that occurs on more days than it doesn't on the markets that I trade, and it's something you can observe yourself. And I just encourage you to do that over the coming weeks before deciding if and how you'd like to trade it, because you do not have to trade this the same way as me. So it's a fairly simple thing to look for. Doesn't mean it's easy to trade, okay? It is fairly simple, but it is going to take some experience of observing the opens to kind of get to grips with the process of trading it. Now, before we consider the opportunity itself, we have to consider what an open is, which might sound like a really silly question, really. Many markets are now open almost 24 hours a day. So if we look at the CME futures, their index futures products open at 5 p.m. Central Time. But anyone that's looked at the index futures at 5 p.m. Central Time will know the markets are just dead, okay? So for many people that work office hours in the US, that would be an ideal time to trade, when they get home in the evening, but there's just not much institutional trading going on. So it's kind of the lull between the close of the US banks to the open of the Asian banks, which is later in the US evening. So even though the market opens at 5 p.m., that's really not what people generally refer to as the open. Now, the US futures markets, they remain quiet until the Asian banks and Asian, Australian prop shops open. So we do have an Asian open, but most US markets still stay fairly quiet at those times. US index futures are quiet. Some markets do have decent range and volume at those times. Crude oil is pretty much active throughout the world because everywhere uses crude. Japanese yen futures, they're examples of markets that are more actively traded in the Asian session, obvious reasons. Later in the day, then we have the European traders join in. So we've got the Eurex exchange in Frankfurt opens. That's when the DAX, Eurostoxx 50 and Bund futures start trading. We get a little uptick in volume then, but most of the time that first hour of the German Open is pretty quiet. If nothing happens in the first 15 minutes in Germany, it's best to go have a coffee and come back 45 minutes later, because that's when the London markets open and that's when we really see the volume pick up. Now, the volume from London is massive. So we have Forex, crude oil, Euro futures, interest rate futures, all seeing good volume and healthy ranges. Now, the stock index futures in Europe, like the Eurostoxx 50, they're not as volatile as the ones in the US, but arbitrage keeps them in line, most of the time. So we have higher volumes and wider ranges once London opens, in comparison to the Asian session. And then we get to the US Open. Well, what is that exactly? Well, for those of us trading index futures, some of us used to call the day session the pit session in reference to the times that the CME trading floors opened. Now that most of the trading floors are closed, or generally the activity on those trading floors is really, really low, it doesn't make sense to kind of call it the pit session anymore. But for index futures traders, the key opening time is when the US stock exchange is open, which is 9:30 a.m. Eastern time. Now, if you're looking at crude, the key opening time is 9 a.m. Eastern time. And that's kind of more for traditional reasons than anything else. Now, of course, there is on the stock market, there is pre-market stock trading, which is generally light, but at 9:30 a.m., the stock market opens to all, and the volume in the corresponding futures markets increases dramatically. So a whole bunch of people and computers come in to play those markets at that time, and that's kind of what we call the open. Now, trading floors haven't disappeared for all markets yet, but for a long time their volume's been really overshadowed by electronic trading. So, with trading floors representing less than 1% of trade in most markets. So it's fair to say that in some markets, if you think of a market like crude, it's more tradition than an underlying market that causes the volume to increase at that market's open time. And it's just accepted that the bulk of US institutional traders come in and start trading at those times. Now that could change over the coming years, okay? So there isn't really a strong argument that, for instance, crude should necessarily really start to see that big uptick in volume at 9 a.m. But for now, that hasn't happened, okay? So most markets, they have an open time, a US morning open time, where trading activity increases because a lot of institutional traders in the US start for the day. Now, people obviously need to start working at some point in the day. So, I think at least in the medium term, we're still going to have this. So, people have positions to put on at the start of their trading day, and they also need to finish for the day as well. So that's why we see kind of a rush of orders at the start of the day and the end of the day. So it's that US day session open that most consider to be the open. But even so, while we might consider the US day session start to be the open, many of these markets are open almost 24 hours a day. So what these markets haven't really done is just opened. They were basically already open. So even those traders that are watching the opening trade on crude or index futures, they're looking at the first 30 minutes from a time, like on index futures, they're watching the first 30 minutes from 9:30 a.m. to 10 a.m. Eastern time. They're actually watching 30 minutes of action of a market that opened at 5 o'clock the previous evening. And this is, of course, the key to trading the open. It is not actually the open. There's information that we can use from Asian and European trading to help us make decisions as the US traders start to engage in the market. Now, in most futures markets, the US leads in volume, but a lot of the time, there is significant volume traded up to the US Open, mostly from Europe. And it's that volume of trading, or rather the positions and the liquidity of these traders into the US Open, that provide us with opportunity as those new US traders come into the market. Now, I would say that this isn't something you can just jump on once you know what to look for. It does require practice and understanding of a specific market nuance. So, if you take all this in today and you attempted to take a trade tomorrow, you might get lucky, you might not, but what you won't be doing is actually taking the trade based on all of the elements required. So one of which is being experienced in this type of action. So watch the opens for a month or two, or just a couple of weeks. Get to understand how your market moves before you consider placing a trade at that time. So most of you, you're going to be at your screens anyway. So all you have to do is watch for the things we're going to look at today. Now, if you jump in and start trying to trade this for the next few days, it doesn't work out, you're probably going to walk away saying, well, that's nonsense, and then move on to the next thing that you give a 2-day shot. If it does work, you might decide to go all in and then get burnt down the road. And this, of course, would put you with the majority of aspiring traders who are very keen, very ambitious, but not very methodical. So just take your time. If you like what you hear today, just take your time to assess whether this opportunity is something you want to take advantage of by having a period of observation. Now, I'm telling you this because what I'm going to show you is going to look extremely simple, and I don't want you to fall into the trap of thinking that simplicity means easy money. Now, the first thing you're looking for into the open are areas where a lot of traders are positioned as you get close to the open. And the best way to show that is by showing a few examples. Now, there's nothing special about the particular dates I'm showing here. This is actually from August 13, 2015. This is still a trade I take 3-4 days a week. It's just this is when I put the presentation together. And I know this is in the summertime, and as you know, usually the volume is quiet. But we had a lucky summer in 2015 in terms of volume. And so some of the days the volume was decent. And we'll come to why that's significant later on. What I will say, if you look at the markets now, right now the markets are quite slow. And what you'll find is that especially a market like the S&P 500, it will quite often put in a move off the open, and then it will move sideways for an hour or an hour and a half. And while it will break out after that hour and a half, it is very hard to catch the break, because you get that initial move off the open, then the market moves sideways, and it's very, very difficult to focus on a market that is moving sideways for an hour and a half. And then when it does break, it's easy to miss it. And I think it was yesterday where we had a very small move off the open, sideways for an hour and a half. Then we had a breakdown and then sideways for the rest of the day. And it was a very, very tricky day to trade. So this kind of trading is going to help you when the market slows down. It's going to help you to get something out of the market early in the day on those days where it's going to revert to a range. Anyway, let's take a look specifically at what we're going to look for this opportunity. So first of all, some of you are going to be asking where the chart is. And I'd say just bear with me on this, because that's not where the opportunity is. In fact, that's why a lot of people say don't trade the open, because they're actually looking in the wrong place for information on how to trade the open. So what we've got here is a screenshot of Jigsaw depth and sales. We don't need to look at everything. The key things that are important here are the time. So this is 5 seconds before the open. And the third column here, this is the volume profile. And that's simply the number of contracts traded at each price, okay, for that session. So we can see we've got significantly more volume traded from 64.50 to 65.75, which is just above where we're trading 5 seconds before the open. And we also have a little bit of higher volume, 63.50 to 63.75 below us too. This volume represents people's positions, okay? It's an area we can say that a lot of trading took place. Now that does not mean that all the people that traded there are still positioned right now. You could say this about any price, but relatively speaking, there will be more positions in these areas because we've got more volume there. Now another thing we can assume is that the closer these positions are to the current price, the less likely they will have stopped out. So if we imagine a trader that went short down here at 58.50, he's less likely to still be in the market right here at 64.25. So he's less likely to still be there, and the market's less likely to react if we go back down to 58.50. Now the volume does taper off at the top, where we can see the high volume at 65.75. It does taper off. You could say, well, I think 66 should be the top, or 66.25. Absolutely agree. Sometimes this will be clearer than others. But I've made 65.50, 65.75 the top of the box. So we got, that's where we have the 10,000, that's where we break the 10,000 level. Now the inner blue and red columns, simply the market depth. So that's people with limit orders waiting for somebody to come and trade with them. You can see that apart from 62.75, the amount of market depth, limit orders, it's quite insignificant. It doesn't mean there's no liquidity there. It just means that traders aren't showing their hands. So we're going to make some presumptions about where liquidity actually resides, based on where the most trades occurred as opposed to where a big number is here. Now, for those who don't understand liquidity, it just means where the limit orders are, or where people are sitting waiting for market orders to come and trade with them. Okay, and here's the open. So a couple of things that I do when the market opens is the first thing I do is I clear the volume profile. I actually have that happen automatically. So I make a note of where the high volume was, and then I clear the profile when we get to the open, because I just want to see, right, what's happening in the day session. So the volume profile's cleared, and then these inner columns here show us the number of contracts traded this time round. So we can see that 5 seconds before the open, we're at 64.25, and we can see that when we opened, we traded a little bit at 64.50, but basically, we were bid 64.25, offered 64.50 before the open, and we couldn't move up. We didn't move up a single tick when we actually got into the open. So in effect, before the open and at the open, we couldn't get in to this high volume area. Okay, couldn't trade into the area, and that in effect is your short opportunity. The thing is, in this case, it's a short opportunity that you would have to have been extremely fast to take advantage of. Now we can see that these bids here at 62.75, they were actually real. This 1,000 bid here, we can see they were real because it took 1,054 contracts to trade through there. But apart from that, there's no significant liquidity anywhere else. Okay, as we move on, we then move up to the top of the high volume area. Now again, there is no evidence there is significant liquidity or limit orders anywhere, because the volume on the limit orders is not significant. Okay, if we look down, the 63.25 area is a slight concern because of the amount of volume traded there. So what we're going to be doing, we're playing off high volume, and if we're going to play off high volume, we take a short off high volume, then high volume below us is potentially a hurdle. So this 63.25 is potentially a hurdle. Now the zero here at 65.50 shows us basically we've moved up to that price, but we didn't trade a single contract there. And right now we're still in the first minute of trading. Now a rejection here is really what we want to see to take advantage of this opportunity. So we've basically got to 65.50, the high of this high volume node, and that's where we'd want to take a short. Now take a mental note of the low is 2062, where 15 contracts traded. And just take a mental note, this 63.25, we had 5,800 contracts there. And here is 4 minutes later. So what we've done, we've travelled to the top of the high volume area marked for the open. It's been rejected. On the way down, we had two prices that we would be worried about. The first is the open price, because a lot of traders have their eyes on that, and it's often a price that holds. If you're not looking at the open price in your trading right now, you really should. It's a really key price. You'll see a lot of activity going on there. It's quite often a pullback or reversal price. The other price that we'd be interested in, 2062, that was the low on the first swing down. So we can see that as we got to 2062, we did trade 1,580 contracts there, and then the market broke down. So there was liquidity there, but it couldn't hold. So how would you actually play an opportunity like this? Well, you could, if you want, put limit orders in at the extremes, or a tick or two short of the extreme. Because if you put an offer at 65.75, the chances are, even if you're right about this trade, you will not get filled at the extreme. Okay, so if you're going to put in an offer 65.25 or 65.50, that's one way to play it. And that's basically, you can do that ahead of time, get a good queue position. The other way to play it is wait for that rejection. So you wait for the market to start moving down away from that level, but getting quickly. Okay, so we had an initial push down off the bottom of the range at 64.50. It would have been very hard to play the first move that we saw early on. It was literally in the first few seconds. But as the market progressed, we're about a minute in, then we move back up to 65.50. That is an easier trade to take. So what I would say is, you don't put a limit order in before the open, or my advice, don't put a limit order in before the open to try and catch it. What you can do, usually the first bounce, if we open very close to the high volume, the first bounce you're going to miss. But then, as long as the next bounce is within the next 3 or 4 minutes, you've got a good chance of the trade working out. Now, sometimes that rejection is very fast, and this is really where the skill comes in, both in terms of taking the trade and then exiting quickly if it doesn't work out. So this one is from 11th of June, and we can see two areas of high volume. We've got 850 to 09 and 05 to 06, and we can see that leading up to the open, if we look at this chart here, we've dropped down to 07 to just about 21.04. We got down to just before the open. So right above us, we've got this high volume area 05 to 06. Now this case is obviously much clearer. So these areas of high volume are much more well defined. The steps in the volume are much clearer. And you will find that when this is the case, this trade is going to work out much more cleanly and much more often. So we opened at 0450, we traded up to 0475, and then we dropped. Now partly the drop was extended by the fact that we've got 1, 2, 3, 4, 5. We've probably got about 70,000 traders or 70,000 contracts in that area. So as we drop, some of the guys in this area are going to get stopped out. Some of the positions in that area are going to get stopped out. And that's effectively why we see this big rapid drop here. Now, obviously, with a trade like this, you need to be fairly fast getting in. It's going to move fast away from the area because of the stops. And you need to be equally fast if price comes back at you. So these are not trades where you allow really large stops, but they are trades where you get good momentum. Now, if you did short this, anything above 06, and your premise for this trade is over. So this is where your own risk management, your own risk profile comes into it, as well as your observations for how the opens work on your market. So you may well need to allow 5 or 6 ticks on crude, depending on, or whatever, depending on how volatile the market you chooses. Now, I scale out of trades, which isn't for everybody. So on a trade like this, I want to try and get 4 or 5 ticks for that first scale. And I'm expecting a rapid rejection. And if I don't get that first 4 tick scale, I'm just going to get a break even if it comes back at me. So I'm not going to sit in this trade for 5, 10, 15 minutes waiting for it to work out. Now, saying that, I'll try not to get in if I can't get a good price. And partly that's because I'm on the S&P. And these opportunities can be short-lived on the S&P. If you're trading the market like crude, you might be able to change that a little bit. But if I can't get a good price, so for instance, if I couldn't get short at 0425, I would pass on the trade. Okay, so sometimes the follow through is fantastic, sometimes it's lackluster, and you just have to cut it. So, on a daily basis, you're coming in, you're finding the high volume, you're hitting into the trade, doesn't work, you cut it, you forget about it for another day. Okay, now if you do insist on a decent price on the entry, it's going to give you more time to manage the exit when the trade's not working out. So it gives you more breathing room in the trade. Now, one from earlier last year, 2nd of March, again, very, very clear from the volume profile that we have significant positions from 1025 to 1075. So the steps in the volume profile, very, very well defined. Now, again, we open here at 1150. We take a tick down to 1125 and then up to 1250. Okay, so effectively that's the bottom, or that's the top of our range holding. Then we swiftly drop to 2110, but we can't make it any further down. So basically we're dropping to the bottom of the high volume node. The longs in that high volume node are effectively holding the market. So this trade is one where you actually had plenty of time to make a decision because it hit the level, bounced up, hit the level, bounced up, hit the level, just probed through it and bounced up. The price did push a tick down and then moved up, but there wasn't a lot of profit in this trade. So you got a good trade, you got a good setup, it did move, we just got to move up a 7 ticks. So that's why personally, on trades like this, I like to scale out because I like to catch something on the trades where the reaction is just a minor one. But you don't have to be rigid with scaling. So normally I'll scale out every 4 ticks. But in a case like this, you see the momentum die, you can take the rest of your position off. So you might scale out 4 ticks, 8 ticks, 12 ticks, 16 ticks. When you see the market hit here, hit 7 ticks here, hit 7 ticks here, 7 ticks here, you don't have to say, well, it's not hit 8 ticks, so I'm going to stay in. You can be flexible. You can see, you really don't have the momentum. It keeps pushing up. It's not going to make it. So you take the rest of your position off. So, the worst case doesn't have to be 4 ticks and then 0 on the rest. If you see the trade failing, if you see the momentum weighing, then, you try and take the rest of the position off. Now, obviously, discipline is really important in this. If you are trading on hope, staying in trades in the hope they'll work out, and the evidence is the contrary, this really isn't for you. So the simple guidelines are, you look for high volume areas into the open. You look for order flow to confirm that the price is holding or it's being rejected. And then you get out of the trade if it doesn't move swiftly your way. Now all days are different, and some days, especially low volume days, are less clear. So despite last year being generally good in terms of summertime volume, you know, this was 2015, August 14th was much more like normal summertime action. And we can see here a chart that's showing us on this day we're going to look at, we had 86,000 fewer contracts traded than for average at that time of the day going into the open. And we can see a rather ugly volume profile. Okay, so you can see we do have an area of higher volume here, 74.25 to 75.75, but it's not the 12, 13, 10,000s we had on the other days, and it's also not so clear. It's kind of, the volume's spread out a little bit more easily or evenly. Now you can see some X's on the left, and that's just basically a column on the depths and sales I used to put in comments. So what I do is I put these X's in just to denote where the areas of high volume are, so that when the profile clears on the open, I can actually still see where the volume is. So I've marked out 74.25 to 75.75, but I've also marked out a few other areas where we're above 5,000 contracts. So what you've got to remember, one of the things that you need to look at this for a few weeks, is that high volume is relative. So when you get a day where the Asian, the European session is lower volume, then you're going to expect a lower volume US session. And you'd also expect it to take, you know, less positions or less liquidity to influence the market. So you don't have to have like a fixed number like 10,000. You're just really looking for outliers for that day. Okay, so we opened the market at 77.75, where we traded those 5,000 contracts. We moved down to 76.75. We traded just 144 contracts there, and then we bounced back up again. And that makes this area a little bit more interesting. We hit the 76.75 area twice. So the first time we hit it, we traded 77 contracts, I presume. And the second time we hit it, we traded the 67. So this column here is showing us just this time round. So basically what it means is we bounced off this 76.75 area twice. And that does make it a little bit more interesting. And this is just 30 seconds after the open. Now we push back down to 76.50 again. We're now 1 minute and 51 seconds after the open, and we're looking for this area to hold. Now we saw 64 contracts trade at 76.50, and then the markets moved up. In total, it moved up 5 points. So the 64 contracts there traded around 9:32, so 2 minutes into the open. So we'd actually seen the market there bounce down, hit this level twice, tick down, trade low volume, and then start to move up. And seeing any of those things, you could have actually got long. Okay. Now for me, the entry comes, or the opportunity comes, as we move up from 76.50, where these 64 contracts trade. So we hit it a couple of times. There was really no interest to trade there. Market starts to lift up. You hit into it. If it comes back down, you just cut the trade. Okay. You're looking for that bounce. Now the next interesting thing is where we traded up to. So we got up to our next zone. Okay. This area here. We didn't trade a single contract at 81.75, and then we started to reverse down. So we saw 81.75 was offered, but no trade. Now we could have taken a short as we start to tick down, and it moved away down from there. But just bearing in mind that, you know, once it's moved 5 or 6 ticks above this area, I'd say that's too late. You know, that's washed the area out. But also, you know, if we hit the top of this zone, 81.50, if you get down to 80.25, 80, personally for me, that's too late to take the short. So you have to be fast on the button with these trades. Okay, just one more. Now this was an interesting day because, despite the low volume into the open, this is just a few seconds before the open, we're 67,000 contracts below average, but we do actually, which is rarer for a low volume day, we do clearly have an area of high volume here, 93.50 to 94.25 or 94.50, And it is much more pronounced than the previous example. So, if it's a more pronounced high volume area, you've got a better concentration of positions, the probabilities are higher. The volume does taper off into the top, but we can still see there's a very clear step here at 94.25. And we can also see that if we get up to 96.25, we can see significantly higher volume from there down to 95.75. And that's where we open. We opened at 96.25. We did move down, so we opened at this high volume area. We traded once inside 650, moved down. You would have had to be extremely fast to have shorted that. So, trading early is one thing. Trading 2 seconds into the open is another thing entirely. You are going to find a lot of the time the market will open on the edge of a high volume area and move away from it immediately. Now, I've not found a way to benefit from that. I'm probably kind of chicken. I'm a bit scared to take those trades. But again, you are going to see that a lot. Now, we move down to 94.50. If you look at the volume trade at 94.50, you can see that just 85 contracts traded. If you look at this 4 here, you can see 4 contracts traded, which is last time round. So what's that showing us is we've hit 94.50 a couple of times. Now, I didn't take this trade on the first hit, but I saw it go down to 94.50, bounce up a couple of ticks, and then move back down again to test it. And that's when I got in. And that was about 30 seconds into the open. Now, there's no reason to say you have to do it that way. So you could have rested an order at 94.75 right from the open. And on trades like this, your chances of being filled, if you put a limit order right at the X's, you're simply not going to get filled. So typically, you need to be a tick in front if you're going to use a limit order. Excuse me. So we got an entry at 94.75. And we already passed the first scaler, which would have been at 95.75. So we ended up getting excuse me, I think I've skipped a slide there. We ended up moving up to 97.75, so we got 15 ticks on that trade, and then we came back down. Okay, so we'd moved up to 97.75, and then we fell back down again. And this time, and you're going to see this a lot as well, where you bounce off one side of the high volume area and you come back to the other side of the high volume area and you get a bounce again. And what will happen sometimes, I will take a trade here and that will fail, and we'll come down to here and I'll take the trade here and that will work. Sometimes both of them will work. So we fell back down this time to 93.50. I was a little bit more wary here because, to be honest, the zone's already been tested. We did move up quite a few ticks, which kind of leads me to think a lot of these positions are going to wash out. But we can see, we got 2,228 contracts trading to 93.75, and on a couple of attempts down to 93.50, nobody really wanted to sell into that. So again, after an initial bounce, I took a long. This was about 12 minutes after the open. Now, the first target at 95 was hit a few seconds later, but in this case, that's all we got out of it. So after the first target, I had a break-even stop, and I got out of it when the market came back down to 94. Oh, sorry. We can see in the end the market moved down to 92.75. This is about 10 minutes later, and then the day settles into its normal behavior. Then we start stalking the kind of normal trades that we would take intraday. Now, not all of these trades will work out. A lot of the skill in taking this trade is in managing the trades that just don't have the legs, the trades that you get into and they move three or four ticks and then they fail. So you need to be nimble, and it's much more important to understand how to handle the trades that come back at you than it is to how to handle the trades that go your way. So you're going to have a lot of trades where you get the bounce and the market just pops. And then you have a few trades where the market bounces a little bit, 3 or 4 ticks, and then comes back at you. And it's those ones that you have to let go of, and that's really the skill in taking this trade. Now, this is not rocket science, but it's certainly a skill. So you should expect that if you try this tomorrow, you should suck, because it is a skill. So the rules are, volume builds before the US Open in a lot of markets. The more volume in distinct areas, the better. More positions, more liquidity. Don't expect the liquidity to be visible as limit orders on the dome. This is all about the flow of orders and positions. Okay, entries are refined with the order flow, which mostly is going to show in a lack of willing to trade at a price. So getting to the edge of that area and just nobody wants to touch it. Everybody's hands off. So you're actually trading kind of a relative absence of order flow. Now, of course, sometimes you're going to get down to the edge of a high volume area and you're going to see limit orders holding the market. But what you'll see if you watch this over the next few weeks, that is the exception and not the rule. Now, the closer you are to an area just before the open, the better. But that also means it's going to happen faster and you're going to probably need to miss on kind of the first bounce and be taking it the second time round. So sometimes it literally opens on the edge of high volume, stays there for a second, moves away. Like I said, that's too fast for me. I've just not found a way to benefit from that. Doesn't mean it can't be traded, just means I haven't figured out how to do it. Now, as you move further away from those high volume areas, the chances of people positioned there still being in the market are much, much lower. Okay, because people don't hold on to positions if the market moves 20 points away from them. Now also, the smaller the range of prices in the high volume area, the better, because those areas are more obvious, the steps are more pronounced, and there's very little ambiguity about where the boundaries are, and also your stop out point is closer. So if you've got 3 ticks of high volume and you get in at the bottom, you short the bottom, the other side of that 3 ticks is where you can say, well, this trade's not working anymore. Now, there's no need for you to jump on the S&P because that's what you saw here. There's lots of markets to trade: energy, agriculture, interest rates, metals. They all have different opening hours. So, you know, you've got the energies that open first, interest rates that open first, then the energies, then the index futures, and then you've got some of the agricultural products that open later. You might find that your markets are easier actually to trade with this setup. Now, there are some markets that you just can't trade with this. So Eurex futures really do close, and there is no overnight volume for European traders to look at. So ideally, US markets that are open during Asian, European trading are the best markets for this trade. You have to get to know your market and when you should and shouldn't trade it, what sort of volume is appropriate, and what sort of spread is appropriate as well. So if there's no real difference and you're kind of making up the difference because you want to take this trade, you're going to need to really iron all that out. Because what you can't do, if you've got 5,000 at one level and 4,999 at another, and you're calling it a step because you want to take the trade, it's just not going to work out. Then you've got to figure out what's your trade management. You could be all in, all out for a small target. That is not a bad approach. I mean, if you're doing this on crude and you just had a 10-tick target, that's not a bad approach. You could do it on the S&P for 4 to 6 ticks targets. Not a bad approach. It's an early trade, 5 or 6 contracts. There's no reason you can't scale in or scale out. Your chosen method is really going to be down to you, and it's also going to impact which trades you can take. So if the other side of high volume is 7 ticks from your entry point, then having a 4-tick target, all in, all out target, is not going to make a lot of sense for that specific trade. It'd be a good time to start typing questions now. This slide is fairly self-explanatory. I'll kind of leave that to sink in a few seconds. The first point is the most important, right? If you're going to take trades when the market is quite fast, the most important thing is, can you get out quickly if it's moving against you? If you're the deer trapped in the headlights, that's like, it's not working, but I'll give it a bit more time, this is going to slaughter you. This is going to kill you because it's just going to zip the other way. Now, for many of you, this sort of trading is going to be a million miles from what you've been told trading is all about. So we didn't really use charts for the entry. We just played off locations where traders were positioned. Now, of course, this doesn't mean you can't use charts later on in the day. So this is just something that occurs at the start of the trading day. And it just so happens that the information that we use from the volume profile is just simply the most appropriate set of information to use at that time for that trade. So it doesn't mean you're looking at this now, you can only look at that later in the day. This trade is something that I saw myself for a long time, and I believed that you couldn't trade the open. And I was sitting there every day watching the market open and watching it over and over again, bouncing off the high volume areas it had made before the open. And I sat there with the belief that it was wrong to trade early, to trade in the first 15 minutes. And then at some point there was just a little light bulb went on in my head and said, Pete, you know, you're sitting here, you can see this happening over and over again. Maybe you should actually try and, you know, maybe you should just, you know, give it a go on sim. And it really developed from there. And don't think you don't have the ability to do that yourself and to develop this idea further. Now, what you've seen today are the tools from the Jigsaw trading tool set. If you want to know more about Jigsaw trading and why we're the #1 software on it, trading software and investimonials, take a look at our website. You can find a lot of details about our trading tools, as well as a lot of free educational material. We've got a course called the Order Flow Foundation course, and it is being used by professional trading firms in Australia and the UK to teach their intern traders. Now, of course, that's partly because the material's good and partly because their instructors are quite lazy. At Jigsaw, we do like to bring our customers together and talk to each other. So we have an active community of users. A lot of people have their own YouTube channels. There's public trading forums where customers log in their progress. We also provide a free chat room where people can meet up, and I attend that personally on most days. It's not a trade calling room, it's not a signal service, it's just a place where we come and chat. We do obviously talk about trades in there, but it's not necessarily a trade calling room. Now, if you read the reviews on Investimonials, you will see our customers benefit from outstanding support, both in terms of supporting the software, also in terms of being able to call us up and have a chat about trading issues. And you can also get outstanding support from Tradovate. And as you can see here, we are bundled with the Tradovate platform, which means basically if you install the Tradovate platform, Jigsaw is already there. You can click on this link here if you want to get a free trial of the Tradovate platform. Tradovate have been very kind in adding a few of the tools that we like to use. We like to use swing charts, or I like to use swing charts. A lot of our customers like to use swing charts. I work with the guys at Tradovate to get those added to their platform. So that's all there. So I would advise to have a look at that platform. Excellent platform. For now, I think we can go over the questions. I think the first question I can see there is, will this webinar be recorded? And it has been recorded. So I will send something out later. Ryan, what is the difference between buying through Tradovate versus standalone?
You know, I think you'd probably, be able to explain the standalone platform better than I for Rapid Trader Pro. If you get Jigsaw through Tradovate, you get access to the depth in sales and recon tape. You also get access to Tradovate, which we have a version for Windows downloadable that works with Jigsaw. We also have versions for a downloadable version for Mac, for web with Chrome and other browsers, and then mobile apps. You get all that access to use all those different versions, or just one of them, whatever your favorite is. There's no extra cost, so there's no platform licensing fees, no order writing fees, anything like that. We have our own depth of market ticket. We have charts. We have a feature with market replay where it's full tick-by-tick data that you get, full market depth. So very handy for looking at market opens in kind of a shortened time frame. You could go back and look at the last week of market opens. You could do that on the weekend, in the evenings, whenever you have free time. And you can look at that in actual time or do it in fast forward time. So like Pete mentioned, it's a skill to kind of learn this trading technique. It's something that a tool like Market Replay, which does work with Jigsaw's depth and sales, you could use to see a lot of different market opens through the last week, the last month, however long you want to go back on the current contract and see how the market's open.
Yeah, I would just like to add to the market replay. It's quite a neat feature in Tradovate. I was kind of help them to test it, but unlike a lot of platforms, you don't actually need to download the data first. So Tradovate take care of all that. So with the Tradovate market replay, you just literally log in, go into replay mode, and tell it which date you want. So it's really you know, you don't have to mess around with data and don't have the data for this. It's a really neat solution. So well done for that, Ryan. We got Al asking if you take Canadian customers.
We don't currently take Canadians, but we are kind of looking at potential solutions for that. So if you're interested, just contact us to drop us your email address. We'll follow up with you in the event that we can accept Canadians.
And do you have a minimum account balance to open an account?
Yes, $1,000.
Okay, well, even I can afford that. Do we have any more questions? I think we're good then, Ryan. So thank you, Ryan, for sponsoring this webinar, and thank you for attending. What I will do is I will wrap this recording up, put it on YouTube, and then I will send it out to you. So thank you all, and thank you, Ryan.
Thanks, Pete.
Okay, bye.